Today we're talking about something super important if you want to buy a home, your debt-to-income ratio, or DTI for short. Now, I know that sounds like a big fancy term, but don't worry. By the end of this video, you'll understand what it means, why it matters when you're trying to get a mortgage, and how to figure out your own DTI. Let's get started. So first, what is a debt-to-income ratio? Well, think about how much money you make each month. That's your income. Now think about how much money you spend each month on things you owe, like your car payment, student loans, or credit card bills. That's your debt. Your DTI is a way to compare how much money you owe to how much money you make. It's written as a percentage. The lower the percentage, the better it looks to the bank or mortgage lender. Here's an easy way to understand it. Let's say you make $4,000 every month before taxes. That's your gross monthly income. Now let's say you pay $500 for your car loan, $250 for student loans, and $250 for a credit card. That adds up to $1,000 in monthly debt payments. To find your DTI, you divide your debt, $1,000, by your income, $4,000. 1,000 divided by 4,000 equals 0.25, or 25%. That means your DTI is 25%. Easy, right? So why does your DTI matter? When you apply for a mortgage, the lender wants to make sure you can afford the monthly payments. They don't want you to struggle or miss payments. A lower DTI tells them you have enough money left over after your debts to pay for a house. Most lenders like to see your DTI under 43%, and some prefer it to be under 36%. The lower, the better. Now here's something important. When lenders look at your DTI, they include the mortgage payment you're asking for. So let's go back to our example. You have $1,000 in monthly debts and you make $4,000 a month. That's a 25% DTI. But if you want to buy a home with a monthly mortgage payment of $1,200, your total debt would now be $2,200. 2,200 divided by 4,000 equals 0.55, or 55%. That's too high. Most lenders would say no to that. So what can you do if your DTI is too high? Here are a few ideas. 1. Pay off some debts. If you can lower your credit card or loan balances, your DTI will go down. 2. Increase your income. If you get a second job or a raise, that can help too. 3. Look for a less expensive home. A lower monthly mortgage payment will keep your DTI lower. Remember, your DTI isn't the only thing lenders look at, but it's a big part of getting approved for a mortgage. Here's a quick recap. Your DTI compares how much you owe to how much you earn. Lenders like to see it under 43%. You can improve your DTI by paying off debt, making more money, or looking for a smaller loan. And guess what? You don't have to figure this all out on your own. That's why we're here. We help people every day understand their DTI and what it means for their home buying journey. If you're thinking about buying a home and want to make sure your finances are on track, we'd love to help. For more information, be sure to connect with us. We're here to guide you every step of the way. Thanks for watching, and we'll see you next time.
Thank you for watching my video. I hope you found it helpful, and I hope you would like to discuss it further. So if you would, please feel free to call me, Mitch Milat, Riviera Financial Mortgage, 424-290-8294. You can also email me, mitch@rivierafinancial.com. You can also find me on Instagram at Mitchell Milat, or on my Facebook homepage, Mitch Milat, Riviera Financial, Beverly Hills. Thank you so much. Look forward to talking to you soon and wishing you much success in the future.